Okay, guys, we are almost there. We've discounted the project's cash flows. We've calculated WACC and cost of equity, and decided to use cost of equity as a discounting factor. Before that, we obtained the actual cash flows for the entire 10-year forecast period. The heavy lifting's been done. It is results time. The first rule of thumb for any investment project, like this one, is to see its NPV, net present value. If the sum of initial investments and discounted cash flows is lower than zero, then there is no point in continuing discussions further. The project destroys value rather than creating it. So, in case 3, we will definitely recommend our board of directors to stay away from the project. In case 1, things change dramatically, and the project starts looking like a very interesting opportunity, given that its net present value is a bit more than 86 million euro. In the base case scenario, we'll have plus 36 million euro. And the project still looks attractive, right? Well, it actually depends what are our other options, right? If the company aims to invest in projects that earn a hurdle rate, meaning a required rate of return, of at least 10%, knowing that this opportunity has a 36 million net present value doesn't tell us much. Instead, we should calculate IRR and see its values, and then compare IRR with other projects. In our case, that's done quite easily. All we have to do is select the entire row containing net cash flows and apply the IRR formula. Please note that we have created this new row called net cash flow plus residual value. The reason is that to apply the IRR formula, I'll need to have both cash flows related to period 10 in the same cell. Okay? Good. So let's see what the IRR results are. Now it is much easier for the company's executives to compare this rate with their other alternatives, as this is a relative measure. Okay, great. There is one last best practice we'd like to show you: adding a sensitivity table. Adding these tables to your work is always a great idea. This is how it's done. First, we have to type in several possible values of a given variable we would like to test. Let's say we've chosen residual value. I'd like to test how the model's IRR changes when we test for each of these variables. Then I'll link to the IRR cell, and we'll select all of these cells, which would allow me to go to the Data tab and create a new data table with a column input. Right. And here's our sensitivity table showing us how IRR changes when we have different estimates of residual value. Such analysis is really helpful for final decision makers, as it allows them to gain an idea of how strong are certain hypotheses in your model, and which are the main drivers that have a financial impact. Okay, excellent. We managed to build a really nice model, which summarizes the output provided from the operations and financial controlling teams. That's perfect. By adjusting the respective scenarios, we are able to see the financial implications of going through with the project in different states of the world. Quite nice, right? And that's what financial modeling is all about, actually. Allowing us to create a credible simulation of different scenarios and hence facilitating an improved decision-making process based on more information.